Welcome to the next installment in our lecture series for American Economic History Online here at Rutgers University Camden campus. And in this video, we're going to be going over Chapter 9 in your textbook, American Economic History, written by Jonathan Hughes and Lewis P. Kane. And we're going to be going over Chapter 19, which goes over the financial developments that occurred in the United States from 1863 to 1914. So we're going to take a look at changes to the financial system, particularly the banking system in the United States, from the Civil War going up until World War I. And before I do that, let me just give you a brief overview of some of the things that occurred in the financial markets in the antebellum period prior to the Civil War. Remember, we had some discussions about the colonial period, and particularly about how the colonists were constantly complaining about a lack of money. And modern economists take a look at that and see that what they were truly complaining about was a lack of specie. They had other forms of money that they used. The colonies themselves printed paper money and other things. Other commodity monies were used during the time period. So let's just realize that the colonists thought they had a money shortage, but when you take a look at how prices increased and how economic growth occurred during the time period, many modern economists believe there really wasn't a shortage of money in the colonies. Once we became a new nation, we ended up having central banking. We had the first bank and the second banks of the United States acting as central banks for the country. The first being from 1791 to 1811, and the second being from 1816 to 1836. So we talked a little bit about the impact that the first and second banks had on financial markets and banking in the United States. And after 1836, leading up until the Civil War, we had a period known as free banking in the United States, where the federal government stepped out of the regulation of banks in the United States, and the states themselves took up that role. And free banking was categorized by loose regulations, is one way to put that. And we took a little bit of a look at the impact of free banking on that, on the economy, and how the free banking experience varied depending on what states we looked at. So now we're going to take a look at what are the financial and banking issues post-Civil War. So if we move on, so the objectives that I really want you to be aware of is, number one, what the National Bank Act was, and particularly the implications of the National Bank Act. What was the National Bank Act trying to accomplish? All right. And also some other banking reforms, particularly in the latter half of the 1800s, that led up to the formation of the Federal Reserve System. I also want you to be aware of something called the Davis Thesis. We're going to go over this in detail. I want you to make sure you understand what the Davis Thesis was and what it was trying to explain. We'll also talk about some issues related to the types of money, in particular the bimetallic standard that the United States operated under and the issues that occurred under the bimetallic standard. In particular, we're going to take a look at something called the Crime of 1873, the Bland-Allison Act, and the Sherman Silver Purchasing Act. So I want you to be aware of all of these particular items as they relate to financial markets in the United States during that time period. All right. Remember that the National Banking Act comes into play in 1863, and I want you to be aware of what the banking system looked like, and it was quite a mixture of things. There were licensing of special charters of state banks. So you could have a bank, for example, in the state of New Jersey. All right? So you could have a New Jersey bank, but you had to have a special charter. All right? So you had to have a legislature pass a law creating a charter for that particular bank. All right, you could have unchartered banks. All right, so realize that you have chartering of banks, you have unchartered banks. Also, the fact that there is free banking that existed. And as I told you previously, that was banking where the regulation of banking was very minimal. So the 1863 Act, the federal government is getting into banking regulation for the first time since 1863, when the second Bank of the United States was vetoed out of existence by Andrew Jackson. So realize that the importance of the National Banking Act is that the federal government is entering into the sphere of regulating the banking system once again. All right, realize that the national banks themselves were still limited. All right, they operated within state boundaries, but they were forbidden from having branches. So, for example, there are nowadays, if you have Wachovia, it's not Wachovia, it's Wells Fargo now. I have a hard time keeping track of all these changes of the names of banks. But if you have Wells Fargo, you realize that there are multiple branches of the Wells Fargo Bank that you can go to in New Jersey, but let alone in New Jersey, but throughout the United States. There are multiple branches. So realize that was a limitation of the national banks, that you could only have one branch. You could have the bank existed in one location, and you could not have branches existing out at other locations. They were considered national banks because of their federal charter. They were regulated by the federal government. All right, and realize that the fact that we had this National Banking Act, and in essence national banks that existed, but we still had a rival state banking system. It did not eliminate the state banks from existing, the states chartering those banks. So I want you to realize that even though the National Bank Act was passed, it did not eliminate state banking as existed. So in essence, we end up having a dual banking system. We have a national banking system, and we have a state level banking system. All right. So the reason why I think this period is very important to understand is that we're still talking about a period of vigorous economic growth in the United States. And in order for this type of economic growth to occur, you need financial capital. Individuals cannot self-finance the expansion and growth of industry during this time period on their own. They need to have funds from other individuals. Therefore, we need financial intermediation. We need institutions that can funnel savings from individuals to individuals who want to borrow that they're able to link savers and borrowers together. So it's important to understand that, and it's also understand the evolution of banking regulation as we move up into the Federal Reserve period. So realize that by the 1860s, that some of the chaos that existed in the banks, that there were roughly 1,500 different state banks in the United States, and their note issues were very much promissory notes. They were a promise to pay gold and silver on demand in exchange for those notes. So, for example, if I had a bank here in Camden, it was Guy's Bank of Camden, and you held notes of mine, what that note meant was that you could take that note, if you were the holder of it, come into my bank and get $100 worth of gold or $100 worth of silver in exchange for those notes. All right? So realize that one, there were some issues with the chaos associated with the fact that there were all these banknotes floating around. And if you're a merchant and you've got to deal with 1,500 different banknotes, how do you determine the value of all these different banknotes relative to one another? How do you know, for example, if you hold notes from Guy's Bank of Camden, that Guy's Bank of Camden still exists and is still paying gold and silver? It might have shut down and gone bankrupt, and you're accepting notes that are worthless. All right. Also, during this period, realize that The federal government was also having difficulties raising money during this time period because there was no large financial institutions. There was these only smaller state banks that they had difficulty selling long-term bonds because there just was not financial institutions large enough to purchase bonds from the federal government. So realize that this is also a financial issue on the federal level, that the federal government had difficulty borrowing money on a large scale because there were no large-scale banks from which to borrow that money. So this required the federal government to be heavily reliant on short-term finance. And you can imagine the additional cost the federal government incurred by always having to rely on short-term credit. All right. And the federal government also had to rely on some financiers to sell bond issues for the government. And there was some issue related to the fact, particularly Jay Cooke was somebody, a financier that they had to rely on, that the federal government shouldn't rely on a particular individual in order to sell bonds. All right, because this individual, particularly Jay Cooke, individuals thought that he would have too much power as the individual who was selling bonds for the federal government, and that they felt that this would give Jay Cooke too much power. So that was this last point here, that there was worries that it was not smart, or they questioned the wisdom of being so reliant on one individual to finance the federal government, that the individual who the federal government was relying on would hold too much power. All right. So realize that this starts to build up during the Civil War. So much of the difficulties that the North in particular, obviously if we can't include the South as they were in rebellion against the North or against the federal government. So this was several years of this occurring and really made it difficult for the federal government to finance and borrow money to pay for expenditures of the war. All right, so that was the impetus for this. Realize that there was a chaotic national state banking system that was in existence, where there were inefficiencies due to multiple note issues from these different state banks, and how exactly do you determine what's the relative value of those notes. Secondly, the limitations on federal finance. That with these small banks, the federal government was relying on short-term credit versus long-term credit because there was no banks that were large enough to provide financing to the federal government. All right, so realize that that was how we address the issue, that setting up a national banking system was the method chosen to dealing with the chaotic note issue of banks, of the state banks, but also to deal with the Treasury requirement of borrowing money. So when they talk about rationalizing the currency, what they meant is having one national currency. All right, so now we have dollars that are printed by the Federal Reserve and they're consistent throughout the United States. That was the same issue that they wanted to address, that if we have one unified currency, it eliminates the need to use all of those different state bank notes. So the issuance of national bank notes would eliminate the variety of state bank notes that were circulating at that time period. Realize that the importance of this occurring during the 1860s, and particularly during 1863 and the Civil War, was that with the outbreak of the Civil War, the opposition to federal regulation of banking was eliminated because much of the opposition to national banking occurred in the South. So once the South was in rebellion against the North, they could not vote against the National Banking Act. So I want you to realize the importance of the National Banking Act occurring in 1863 was due to the fact that during the Civil War, the South not considered part of the United States and therefore did not vote. And much of the opposition to national banking came from those southern states that were in rebellion. Since they were in rebellion, they didn't get a chance to vote. I want you to realize that also there was a natural progression to the National Bank Act. In particular, that the initial act that was passed really didn't get many banks to convert to the national banking system. All right, so the initial act was passed, but it really didn't have the impact that was intended. Many of the banks, the state banks, stayed state banks and did not convert over into national banks. All right, so there was a couple of things that got passed post the Act of 1863. All right, and the comptroller of the currency changed the capital requirements to a sliding scale. So, for example, if you were in a large city, in order to become a National Bank Act, you needed $200,000 of capital for a city over 50,000. But if you were a smaller city, say of less than 6,000 or less, you would only need capital of 50,000. All right, so it changed the capitalization requirements to make it easier for these national banks to start up in smaller cities. So initially there was one level of capitalization for all national banks, but this was altered to a sliding scale to try to accommodate the creation of national banks in smaller cities. All right, also to capitalize these national banks, they were required to buy federal bonds. So 1/3 of their capital had to come from federal bonds. And if you look at this, what does this National Bank Act do? Is it shores up the federal bond markets because it increases the demand for federal bonds. National banks were required to purchase federal bonds. So the issue that the federal government had with raising money is partially eliminated because you're going to require national banks to purchase federal debt. All right? And when those bonds were deposited with the comptroller, they would be given national banknotes at an exchange rate of 90% of the face value of the bonds. So I want you to realize how these national banks got their note issue, that when the capital was deposited with the comptroller of the currency, that they were given these notes in exchange. Realize that national banknotes were made legal tender, an important requirement. Realize that this is important because remember when we talked about the Civil War, one of the issues with Southern currency, paper money of the time period, was that it was not made legal tender. So that undermined the value of the currency. The same mistake was not made under the National Bank Act. National banknotes were made legal tender except for customs payments. Customs payments still had to be made in gold and silver. All right. Also, to make sure that the system was more sound, they required reserve requirements. All right. So this gave it a distinction over the state banks, that there was a reserve requirement was in place for the National Bank Act. So if you became a national bank, you were under a system of reserve requirements that was more stringent than the state banks, which made the national bank seem sounder, be a safer place to put your money. Also, the national banks faced double liability, that if they did not pay back, were able to pay gold and silver for the notes, etc., that they would have to pay you double of what the liability they actually had. So all of these were intended to try and get deposits away from the state banks, to try and distinguish the national banking system, the national banks themselves, from the state banks, saying that the national banks are safer, that they have reserve requirements, the regulations are tighter, and that way people would take their money out of the state banks and place them with the national banks. Also, realize that in order to try and put additional pressure on the state banks, if we take a look, we will see that there was taxes placed on notes in circulation. All right? So that the taxing on, for example, the national bank notes was less, 0.5%, versus 2% versus the state bank notes. All right. So I want you to realize that there was a tax benefit to being a national bank because any of the notes that were taxed of national bank notes were at a 1/4 of that tax that was placed against the state bank notes. So once again, it's placing a burden on the state banks, a financial burden of issuing notes and making that burden much less of national banks. In essence, what they're trying to do is force state banks to convert over into the national banks. All right, finally, this tax against the state banks was continually raised during the time period, again putting additional pressure, financial pressure, on the state banks, trying to get them to convert over. So I want you to realize that the taxes on state bank notes was increased and increased up to 10% to further put pressure on state banks to convert over to the national banks. And realize that this final taxation of the state bank notes raised the cost of operating state banks relative to national banks, and most of the remaining state banks converted over. So I want you to realize that the vehicle that was used to get state banks to shift over to national banks was this differential tax rate, that the notes of state banks were taxed at a much higher rate than the national banks, and this proved an incentive for banks to shift over. All right, realize that state banks dwindled up until about 1870. All right, so I just want you to realize that this dwindled, but again, the state banks figured out on money how they could make money without issuing notes. So what happened is that the state banks realized that they could still do business without issuing the state bank notes, which they were being taxed very heavily on. All right. So realize that this did not cause the state banks to disappear completely. It did provide incentives to move over to the national banks, but the state banks themselves started to realize that they could still make money without issuing notes. So it did not diminish or cause the state banks to cease to exist. All right, and I want you to realize that if you take a look, even by 1900, the percentage of notes held by state banks was still roughly 50%. So I want you to realize that even though the federal government was attempting to, in essence, eliminate the state banks found a way to continue to exist, and even to the point by 1900, state banks constituted roughly still 50% of the notes in circulation in the United States. So if we take a look at the total in national banks, and oh, that doesn't look too good. Let me fix that up a little bit. There we go. Apologies for that. That looks a little bit better. All right. And start to realize that here we see the national banks starting to grow in importance. And remember that time period going up until 1870, that you see the number of state banks shrinking, and you can see that number. But then they start to grow past this time period, that break point of 1870 where it starts to grow, where the banks started to realize that they can actually do business without relying on those notes. So you can see the number of state banks starts to grow from 1870 onward. So you can see that the national banking system attempted to almost eliminate the state banks, that you see dramatic growth in the number of national banks occurring from 1863 to 1870. We see a contraction of the number of banks in the state banking system, but after 1870, we see that the state banks start to actually rebound. They realized how to do business without having to issue those notes, because those notes were taxed at a much higher rate. And as you can see, what do we see? The percentage of bank assets, national bank assets, as a total of all assets. If we take a look, we can see that by 1865 and going into 1870, roughly 90% of the banking assets in the United States were national banking assets, but then we can see that this declines during that time period. So I want you to realize, number one, what the National Bank Act attempted to do. It attempted to wrest away regulatory control of banks from the states to the federal government. And it was successful going up until 1870 in actually doing that. But after that time period, the state banks themselves started to realize how they could remain profitable without producing the banknotes, because those banknotes were taxed very heavily at 10%. So once they realized how to make money without issuing banknotes, we could see that the state banks themselves started to increase in number, but also increase in assets relative to the national banks. All right, so that's all these do, is review what occurred in that previous table here. In 1863, national banks had less than 2%. By 1864, it was 26%, and by 1869, that had risen to 90%. After 1870, we see a precipitous fall, and by 1890, we see that the national banks held roughly half of the assets of all the banks in the United States. We also see the development of checks, depositing and checking system in the United States. All right, and that's the way the checking and development of checks in the United States was a way that the state banks could circulate their notes, circulate and make loans without actually circulating banknotes. And remember, these banknotes were taxed at a 10%. So what they could do is they could loan money out in the form of demand deposits, writing a check to the individual and transferring that money into their account and allowing them to write checks on that account. So they're not physically printing money, but they're creating deposits by allowing individuals to write checks on a particular account. So that's the other thing I want you to realize, is that the development of checkable deposits and writing checks in the United States was a direct result of the national bank tax of 10% on state banks. The states realized that they could avoid, before when they made loans, they just printed banknotes and gave them to the individual. When they did that, they were exposed to that 10% tax. Once they realized that they didn't have to print notes in order to make loans, they could just allow individuals to write checks on a particular account, they avoided paying that 10% tax. So the fact of the checking and checkable, quote, deposit development in the United States was a direct reaction to the tax placed on state banks by under the National Bank Act. All right, and think of the demand deposit and a check as just a bill of exchange, in order from the principal, the check writer, to the bank to disperse funds to that third party. All right, and realize that we take this as something for granted, but that was a major innovation at the time, and it was an innovation by the state banks in reaction to the taxes under the National Banking Act. So make sure you also realize that if you're going to use these checks, that the banker had to honor the check, and the seller had to be trusted in the ability of the principal to actually pay that nobody would accept these checks unless they thought that they were actually going to get paid for them. So in essence, the bank is actually acting as a financial guarantor to the individual they make the loan, that when they write this check to the person that they make the loan to, and this person is taking that check and buying things with it, the bank has to honor that. So the bank is providing the loan to the individual, but is backing the loan. All right? So realize that that was an innovation that occurred, that previously in the banking system in the United States, that when banks made loans, they printed banknotes and gave those banknotes to the individuals. Now the banks themselves are shifting to a system of checks and checkable deposits. So I just want you to realize that what the National Bank Act actually successfully did. It did convert a lot of state banks over, but realize that they did not eliminate the banks completely themselves. All right? And realize that there was an issue of national banknote circulation varied among the states. For example, Rhode Island is an example that had quite a few national banknotes. had $70 worth of banknotes circulating in Rhode Island versus per capita only 13 cents in Arkansas. So their notion of trying to have uniformity amongst the states, they never really addressed that issue. There wasn't a uniformity of banknote issue, national banknote issue. Also, that reserve requirements were rescaled to allow for easier entry into smaller towns. So the National Bank Act not only addressed the sliding scale for capital requirements, but also the reserve requirements were adjusted for smaller towns. All right. Realize that when they say the national banking system, that quote-unquote system part of it doesn't really hold. It wasn't really a national system. It was an attempt to have a national banking system, but they never were fully successful in eliminating the state banks as a viable secondary banking system in the United States. All right, and with the national banking system, it was still difficult to clear checks across different sections of the United States. The national banking system, there was, for example, no federal banking system. There was no Federal Reserve. There was no central institution of regulation and coordination of the banking system. All right? And this became evident in several financial crises that occurred in the late 1800s. There was a crisis in 1873 and in 1882. All right? That were so severe that the national banks themselves almost ended up closing down, along with some state banks. All right, and there was also panics in 1893 and 1907. So I want you to realize that this final period of the national banking quote-unquote system was pockmarked with some drastic financial panics that very much undermined the banking system. All right, and realize that all banks almost universally suspended the conversion of specie. That if you went in with a banknote and said, "Give me gold or silver for this," the banks would refuse. All right. Call money rates. That's interest rates on short-term loans. Reached 70% in 1893 and 125% in 1907. So I want you to realize that even though the National Bank Act was put in place, that one, it didn't eliminate the state banks in existence, and two, it did not eliminate financial panics. And these final financial panics, these four financial panics that I talk about, 1873, 1882, 1893, and 1907, were an impetus for further reforms in the banking system. All right, so people realize that after 1907, that these panics that are periodically occurring, it seems like every 10 years, that there was a drastic shortfall in how the banking system was regulated in the United States. Also, the fact that there was no provision of liquidity available. There was no central bank that could say, you know, we have a liquidity crisis, a short-term liquidity crisis. We will pump the necessary liquidity to keep these banking panics from actually occurring. All right? So realize that all of these financial panics that occurred during the national banking system was an impetus for further regulatory changes to occur. All right? The Treasury actually had issued these clearinghouse notes, but in essence, the Treasury basically was issuing its own currency, which was of dubious constitutionality at the time. So the Treasury, and in order to issue deposits and help banks out, were actually issuing its own notes, these clearinghouse notes, even though they weren't considered money. In essence, that's in what they were doing. All right. Also, during this time period, I want you to realize what occurs with the price level. And I want you to realize that this was a period of a deflationary period going into 1900. That once we get past these price peaks during the Civil War, I mean, you can see that the price of wheat goes up dramatically during the Civil War. We can see the consumer price index and the wholesale price index increasing during the Civil War. If we look from 1870 to 1890, we can see that there's a long-term trend to falling prices in the United States. And I want you to be aware of that for a number of reasons that we'll talk about later. Also realize that J.P. Morgan, the financier, played a huge role by Morgan. That Morgan actually was able to mitigate much of the issues that happened in the panic of 1907. All right? He pulled bank funds, there was rationing of credit, and he also made sure that individuals who were speculating in the stock market, they were disciplined for doing that, i.e. they lost their money. If you speculated in the stock market and lost, you didn't get a quote-unquote bailout. All right? But what he did, in essence, was act as a central bank. He acted very similar to what the Bank of England would have done during the same time period. So once again, the same issues with people being leery of Jay Cooke having too much power. People became leery that J.P. Morgan basically was bailing out the financial system, the financial markets in the United States, and individuals felt that this is inappropriate, that one person should not have so much power to be able to bail out the monetary and financial markets in the United States. All right, so here's a couple of acts on the national banks that you should be aware of. Number one, Aldrich Vreeland provided for temporary emergency currency during financial panic. So it legally gave the federal government the ability to provide temporary funds during financial panics. Also, the National Currency Association was formed, and also the creation of the National Monetary Commission. The National Currency Association was to try to take a look at what could be done to allow there to be elasticity of the currency, that the money supply should be able to expand during financial panics when there's a credit crunch actually occurring. And the National Monetary Commission was suggested to be put together to take a look at the banking system and how could we create this banking, I don't say create this banking system, but mold the banking system in a way that it was more stable, that we wouldn't have these periodic, it seemed like every 10-year financial panic. All right? And the commission itself recommended a National Reserve Association, the precursor of the Federal Reserve, organized into 15 districts, and that they would be owned by the private banking interests, but they were to be federally sponsored. So this leads us to the Federal Reserve Act of 1913. Make sure you realize that because of the issues that we saw previously, so we have a hybrid, we have the banks are owners, but also that the federal government is also involved. The Fed structure was actually altered in 1935 during the Great Depression to look a little bit more like government. And realize that there was this belief that it should not be a monolithic central banking structure as the Bank of England. That we had 12 regional banks located throughout the United States. Also, that they realized that the issues from the first and second banks, that the charter of the Federal Reserve does not expire. Therefore, it does not have to be re-voted on every 20 years to be reincorporated. And also realize the Fed does not compete with the banking system. The first and second banks were competitors to the state banks that existed. The Fed does not compete with the state banks or the banks that it regulates. All right, realize that if you're a member bank of the Federal Reserve System, you have to deposit certain amounts of cash, which you don't get interest for, with your district bank, which very much mimics the Suffolk system that we talked about previously, where you have to keep reserves on hand with the regulatory body. Reserves were scaled by the size of the city, much like the national banking system. All right. There was originally provisions for deposit insurance, but the bankers themselves opposed this, so this was initially dropped. And after 1929 and 33, we realized that deposit insurance was added, very much like the New York Safety Fund that we talked about previously. National banks were forced into the Federal Reserve System, and they bought stock into the district banks. All right. And realize that this also set up the Federal Reserve System of the 5 directors, but also realize that the representation is spread out. There's 3 representatives from banking, 3 from business, commerce, and agriculture, and 3 representatives from the public. The Federal Reserve Board is in charge of all this. They're the head honchos you can take a look at. All right, and realize that the president appointed the 5 other members of the board on staggered tenures. Realize that this is important because this prevents any president from loading up the board with his appointees and having too much control over the Federal Reserve. Make sure you also realize the notion of financial intermediation that I talked about previously, that the notion of having linking buyers and savers together. So you have to collect savings, but you also have to make it available for individuals who want to use that money to build the infrastructure, to build plant capital, etc. All right. So those are the main points that there. Also realize that there's a notion that we have to talk about with the greenbacks. Remember, the greenbacks were the currency that were issued by the North during the Civil War, and realize that they were, they were printed in large volumes, so there was a level of inflation. For example, the prices doubled in the North during the Civil War. So in order to get these greenbacks out of the market, there was 2 different ways that you could go about doing this. You could allow the economy to grow. So you could keep the money supply constant and allow the economy to double so that the price level would go back to its original level. Or you could take this money out of circulation. You could cut back on the money supply. So there's this resumption. There's 2 ways you could go about resumption. You could you could keep the money supply constant and allow the economy to grow to this money supply, which would mean that the price level would fall back to its pre-war levels. All right, or you could shrink the money supply and immediately get back to that pre-war price level. So if you cut back the supply of greenbacks, all right, there's a problem with that. If you cut the money supply, the economy is going to move into a recession. So that's what was initially attempted by individuals. They actually cut the money supply and they ended up causing a great contraction that actually occurred. So it was finally decided that instead of contracting the money supply, we'll just try to keep the money supply constant, and we will see as the economy grows, the price level will slowly shrink back to its pre-war level. If we go back to that figure I showed you, which very much mimics what happened in the United States from 1870 to 1900, there was a dramatic fall in the price level, or a consistent fall in the price level. Realize this notion of what the crime of 73 was, that the Coinage Act of 1873, not 1973, I'll have to make an adjustment to that, omitted any provision for the coinage of silver. Silver was dropped from the Coinage Act. Well, the thing is, it wasn't circulating at the time because it was undervalued at the mint. It was overvalued in the marketplace. So people were taking gold to the mint because it was the more attractive investment. It was better to keep silver not circulating because it was overvalued in the marketplace. Well, what happens right after that period is that the output of silver soars with the finding of this Comstock lode in the West. So silver is getting produced at dramatically higher levels. The price of silver falls dramatically because of this increase in supply, and people start taking that silver to the mint to get it coined, and guess what? It's no longer being coined. So people were very upset with this, and they call it the crime of 73 because they thought it was some conspiracy that they secretly dropped silver from the Coinage Act. But what happened was silver wasn't being brought to the mint. So it wasn't dropped. They just wrote the law that way because nobody was bringing silver to the mint because it was undervalued at the mint, i.e. being overvalued in the marketplace. So people were bringing gold and not silver to the mints. So to deal with this, there was something called the Bland-Allison Act. The Treasury was required to purchase between 2 and $4 million worth of silver at market prices every single month. And this was hoped that it was going to stabilize the price of silver as the price of silver kept falling and falling. Well, this did not successfully stabilize the price of silver. So then we have the Sherman Silver Purchasing Act of 1890. So basically, the Treasury had to purchase 291 million ounces of silver at the price, but the price of silver kept falling during this time period. So what happens is basically the federal government is stepping in and trying to put a floor on the price of silver by purchasing the silver at specific prices. It also doubled the monthly purchase rate, but the thing is, silver kept the supply of silver was increasing so much faster than demand that the price of silver fell dramatically. And this caused a problem where we're trying to support silver and then gold starts flowing out of the country. So we see that the gold reserves of the Treasury fell below the $100 million minimum that it was allowed to have, and that the Sherman Act was repealed. So when we talk about the Panic of 1893, a lot of it's related to the fact that the federal government was trying to support silver prices and trying to support this bimetallic standard. So I want you to realize that all of this basically left us with the Gold Standard Act of 1900. We were no longer on a bimetallic standard. We were on a strictly gold standard.